Hello and welcome to this week's Australian Stock Market Report. Now Australia's both on fire literally and when it comes to the stock market. So this week we'll be looking at both of these and how they might affect you. I'll then give you my thoughts on the Australian stock market, where it's heading, along with answering your questions and looking at stocks for you. Hello, I'm Dale Gillham, the Chief Analyst at Wealth Within, and we're Australia's most trusted stock market educators. Now before we move on, thank you for showing your support for the channel and hitting that subscribe button. Now as you click the subscribe button, click the bell on the right of it so you keep up to date with our latest videos. Also tune in to our live Australian stock market show every Tuesday, 7 to 8 p.m. Australian Eastern Time. This is the show where you get to ask us, the stock market education and trading experts, to look at your favourite stocks and answer all of your most burning questions. Now over the last few months we've seen a number of catastrophic fires hit our country, while at the same time the stock market has also been on fire, rising over 5.5% since early November and over 5% in January alone. We all know that the bushfires will eventually be extinguished. But what we don't know is at what cost to our economy and how this will affect the stock market. There is no doubt that the bushfires will impact the economy as government funds are diverted to the relief effort. Further, given the severity of the fires in the farming community, we'll initially see agricultural output fall, along with tourism and lost jobs in the fire impact zones. Whilst the economic cost is unknown at this point in time, it is expected to eclipse the impact from the Black Saturday fires at $4.4 billion. That said, let's not forget the ongoing drought in Australia has already had a significant impact on our economy. We also need to consider the impact on tourism in Australia, as graphic images of bushfires and dangerous smoke conditions are shared with the world. This means international tourists are cancelling bookings and are more likely to choose alternative destinations for their holiday in the coming months. All of this will have a flow-on effect to various companies in the stock market. As with any catastrophe, there are always casualties, and with bushfires, it's always the insurance and agriculture industries. Whilst insurance companies manage their risk through reinsurance, they are still somewhat exposed to these large natural disasters. Farm services and equipment suppliers may also be hard hit. There are also many service industries supporting the agriculture and tourism industries that will severely be disrupted. Banks will also be affected, as those who have lost their jobs or are temporarily out of work will be unable to pay their mortgages. Consumer spending may also be temporarily impacted. Whilst all of this is likely to have a negative impact on the Australian economy, I also believe it will be short-lived. Humans adapt to situations and rebuild very quickly. And I believe the economy will be the winner over the next few years, as the relief effort will have a positive impact on the economy. We will see a boost to construction, roads, power and many other services supporting the reconstruction, which will bring with it jobs and require greater demand for raw materials. On top of this, we'll have the human factor, as people affected will be purchasing all manner of items and services for themselves and their homes as they rebuild their lives. With every negative, there's always a positive, and while the fires have been devastating to so many, the sun will shine again and many positives will come from it. So what are the best performing and worst performing sectors in the Australian market last week? Well, as I mentioned, the market has been very bullish, with information technology leading the way, up 3.8%, whilst consumer staples and materials were up 3%. The worst sectors were energy, which was just in the red, whilst utilities and healthcare were up around 1%. The best performing stocks in the ASX Top 100 last week include Evolution Mining, which was up around 9%. This was followed by CIMIC up over 8% and Northern Star up over 7%. Now surprisingly, even with the fire raging around the country, QBE Insurance was up over 5% for the week. Now the worst performers so far include Pendal Group and Virgin Money. Despite doing very well over the past 2 months, both fell over 5% last week. Domino's and Caltex were also down, and they were down 2% for the week. So what do I expect in the market moving forward? Well, let's get into the charts of our S&P 500 All Ordinaries Index update for this week. We'll also answer your questions and have a look at the stocks that you've chosen for me.
Please remember that this report is an educational tool. While Wealth Within holds an Australian financial services licence, the information featured in this program is general in nature and therefore should not be relied upon. Before making any investment decisions, you should consult a licensed professional who can advise whether your investment decisions are appropriate for you. We hope that you enjoy this week's report.
Well, what a fantastic start to 2020 for the Australian stock market now. As I probably said last week, I did think our market would rise up into Christmas, but the rise was a little bit delayed. And that's some of the thing with the stock market. Whilst you know the direction, or finding out the direction is not that hard once you know how and have all the techniques to understand like I do. But trying to pick the exact bottom or trying to pick the exact top does get a little bit harder when moves happen, because after all, the market is a reflection of our collective psychology or our mood of the people. And if people aren't in a strong mood, they won't drive the market. But what we've seen currently this year is a phenomenal rise on our stock market. So let's go and have a look at the charts right now. Now on the screen is my normal chart. It's a weekly chart of the All Ordinaries Index. It's still got my my arrow here where I'm suggesting the market will probably go to. Now looking at this, you can see here how last week, this is a weekly chart, last week the range of that bar was 211 points, closing at 7,180. Now, for those of you who've been watching these reports for some time, you'll remember that I've been chatting about our market rising to 7.2 to 7.6 before the next peak. So we've nearly hit 7,200. And it's quite interesting to me because I do get people commenting on Facebook and on my YouTube channel, saying, well, what about this? The market's overheated, it's going to fall away, it's going to crash. You get all these different people that read reports from around the globe thinking everything's doom and gloom. And that's been happening to me for, over probably 4 years. People are putting comments on some of my market reports and my blog posts and those sorts of things saying, hey, you're crazy saying the market's bullish, and yet the market's continued to be bullish during that time. So this is where I have that contrarian view to the market. A lot of people, as I said, they're bombarded by the media, and I was chatting with some gentlemen in the US last week. I was having a conference with them about the market and everything else, and they say, in the US, there's a lot of fake news, not just about President Donald Trump. There's a lot of sanitized news about what's going on here, but I think the markets are looking really, really good at the moment. So now is the time to profit. Now's the time to be good stocks. So, but looking at the chart, where is it going? I think what we're looking now is for a short-term peak. It's likely to happen somewhere in the next couple of weeks. Now, I expect it to happen, so we might get another bullish week here this week. It may not be as bullish as last week or the last 2 weeks, but I'm expecting probably till the end of January we'll be rising, so maybe another 1 to 2 more weeks, and then we'll start falling down into a shorter term low, probably somewhere around this sort of mid to late February, and then we'll take off again. So I do still think our market will hit 76,000 points, but as I said, at the moment, my bottom target is 7,200 points. My higher target is 7,600 points. It is quite possible we'll get another 1 or 2 more really, really strong weeks out of our market and hit up to that 7,600 points, or getting close to it. That's 400 points, which is 2 more weeks at 200 points a week, which we did last week, remember? The week prior, it was also a 200 point range. So there's only 2 more weeks at 200 points to get 7,600 points rise out of our market. So it is still possible. I don't think it is as possible. I mean, to me, 7.2 is the area that we want to be in, minimum, but we'll probably sit somewhere between 7.2 and 7.6 when we get this next short-term peak, running down into a little low for a little while, and then we'll take off again for the eventual high for the year. But I do think this first half of 2020 is good. But let's go and have a look at the stocks, the questions that you have for me. Now, the first question we've got today is from Dom, who says, hi Dale and Janine, thanks for the content that you provide. I'm up to your second book now and almost completed reading it. Well, thanks for buying my book, matey, and I'm glad you enjoy the content. He says, I have a few stocks that I've bought since reading both your books and want to see your thoughts on ORA or Aurora. Buy price at $2.92, purchased on the 27th of September last year. Great for giving me those prices, because that really does show me what you're thinking at the time and why you bought it, or so I can make some comments on that as well. And currently just over 10% in profit, which is fantastic, buddy. It has been trading sideways for the last 9 weeks, so I have a falling sell at $3.12. So I'm not sure what a falling sell is or how you're setting that, because you haven't explained that, but a falling sell, I'm not exactly sure what the rules are around here, because he says because this has been its lowest low. Oh, there we go, you explain it, sorry. Because it has been its lowest low during those weeks, and I think if it falls further, then then I will sell. Just looking for your thoughts, if my thinking is correct and would treat this any differently. Well, my thinking is a little bit different as well, because just because a stock falls below a lowest level that it had a few weeks back doesn't constitute a sell in my book. It's actually way too tight. The biggest sin of traders is they set stop losses far too tight for fear of losing money, and what actually happens is they lose more because they get out of stocks that are just, stocks will fluctuate. It's just like walking up and down stairs. You got to lift your foot up and then put it down again, and lift your foot up, put it down again to climb higher. Stocks do exactly the same thing, and when you set stop losses too tight, people do so because they're fearing losing their profit or fear of losing their money. Now, I've had stocks that are 10 and 15% in profit and fall 5% to 10% in a loss, and then gone up and made me 100% because I allow it to unfold again. And that's really what you need to do. If you really are afraid of losing money, then you need to understand what stop losses are and how to use them properly. But right now, I think 10% or so, that stop loss under the low is probably a bit too tight. But let's have a look at the stock itself. And you said you bought that in September back here. So looking back on to here, you bought it back in September somewhere around $2.90 something. So there's the end of September there. The 27th, so $2.92. Not a bad place to buy it, so it's pretty good. And right now it is looking all right. It has gone sideways a little bit, but that's what stocks do, matey. That's really, so stocks go from equilibrium to disequilibrium. What I mean by that is the buyers and sellers. You get buyers go to disequilibrium where one side overpowers the other and takes it up to the next level, and then you get a bit of equilibrium whilst the buyers and sellers agree, because what happens is price takes off. And then you get people starting to take some profits. You also get people not wanting the price to go too far, so they pull back on their buying. So big institutions will pull back from buying this stock just to let the price float down a little bit before they come back in and buy. And that's really why I said to you, you don't really need to have such a tight stop loss on this stock. It does look really, really good to me. It looks nice. It's been a little bit weak last week. It's trading all around that same range, but 9 weeks going sideways is pretty much nothing. Be patient. The best thing that stock market will do is teach you to be patient, and you really do that, because what I see a lot of traders do is trying to make money quickly, and they're being very, very impatient. I'm not suggesting this stock is bullish or bearish. I think it's more bullish than bearish, and looking at the monthly chart there, it still looks quite nicely at the moment, and that's what I would suggest you do. Take a bit more of a pullback and a little bit more a longer term view on that. But thanks for the question, and thanks for the books, and get back into them, have a look at stop losses again in the book. The next question we got is from a lady called Mary Ruth, and she says, what do you think of the stock VHT? Healthcare sector in general has been performing really well. It has in the last few years. CSL, Cochlear, they're doing quite well. So is ResMed and a few other stocks. It's a fairly new stock, but I feel has heaps of potential. As me personally am working with the healthcare sector, I've made a very, very modest buy in with VHT, but would appreciate your thoughts on it. Thank you. So let's have a quick look at the VHT. Now, looking at the chart, I'll just bring that up for you right now. We'll get it from Aurora. As you said, it's relatively new, 4 years old. It's been very, very bullish, rising from around that sort of 30-cent mark, moving right high, right up to this high here, up at $2.50. Massive rise. But you can see here over the last sort of 2 years here, or 18 months, it's really been going sideways around that $2.80 to $2 sort of area there. It's not looking super strong. Now, I'm glad you've only got a small position in it from that point of view, because it does makes that it's a nice way to dip your toe into that water. I still do like the healthcare sector. I do like it medium to longer term, although some of these stocks have run too hard and they need to pause. And this is really what this stock has done. I'd say it's really paused around these levels to catch up, because it did, if you look back on that monthly chart there, it went very, very rockety. It wouldn't surprise me if it gives us a direction soon, given it's been this sort of sideways move-ish. If it does start to fall away and starts falling below that low, I'd be starting to consider exiting the stock, but right now there's no need to at this point in time. I'd suggest you buy my book, because at the end of the day we'd be able to teach you some of the stop losses and exit strategies that will protect your money, but I wouldn't be adding to my position right now, if that makes sense to you. But thank you for asking the question. The next question we got is from Ricky Hayes. He says, what are your thoughts on Australian ASX company Xero? I actually love Xero. Xero is a really, really good stock. It's one of the wax stocks in Australia. Like the US has got their FANG stocks, we've got our wax stocks, and obviously Xero is the X in that. So let's have a quick look at the chart of Xero. It's been doing very, very well, but again, it's another one that's really taken off like a rocket. If I use my little tool here, you can see since 2015 this stock has risen to the close last Friday of 619%. Stocks that rise that long and that high and that fast in terms of percentage terms eventually run out of steam, and so this is where you've really got to protect yourself, Ricky, is if you're not in this stock, I would suggest it's possible, if you do get into it right now, you do need to keep a stop loss on it, because I wouldn't suggest it's going to repeat what it's done. If I put the last few months in here, from this low here, which is from November 2018, so 13 months up to here, you can see it's risen 133%, or a bit more than that actually, nearly 140% there over the last 13 months. So what will go fast is generally what will happen is people go, or the industry says it's now getting too expensive, and they stop buying this and going into other stocks in a sector that they like, whether it's this technology sector or some other stock. So I wouldn't suggest it's going to make it. I definitely won't suggest it's going to make 100% in the next 12 months. So again, I would probably pick better stocks if I was looking for purchase. If I did own this stock, then I'd be just having a stop loss on it and just managing it while it's going up. So stay with stocks while they're rising, get out while they're falling. We do have another question, or a couple more questions. We got one from, I'm not sure I'm going to say your name right, matey, but so I'll just call you Ash if that's okay, matey. He says, hi Dale, I have purchased your book recently. So far I've learned quite a lot from your book. Fantastic, thanks very much for that. Yet to complete the full book. I would appreciate your valuable comments on Centura Metropolitan REIT. Please keep up the good work educating investors. Well, I'll keep educating investors. You keep reading the book, matey, and hopefully you get a lot more out of it again in the last part of the book. But let's have a look at CMA. Looking at this, it has been a little bit more bearish lately. So we're seeing from September it's now coming back a little bit there on the chart, but last week it was looking quite good. Again, another one that's been quite strong and quite bullish, and I wouldn't suggest it wouldn't be, being a REIT, so it's a real estate company. So real estate's been doing well the last couple of years, so it's looking okay. If this thing starts falling away below these sorts of sort of 287 or 280 sort of area, then I wouldn't be owning that stock. But whilst it's moving up at this point in time, stay with it. It's nothing here that says to me this is going to fall over. I'm just saying right now, just protect that downside just in case it does, because it did have a pretty spectacular rise through the last sort of 12 months. If I put my little tool on here from November 2018 to there, you can see it's 43% and about 32%. So it's not a bad little stock. Given the market rose about 20% last year, so it's going quite well, and that for real estate is a quite nice move in real estate, or a real estate type of stock. So but stay with it, looking really, really good at the moment. The next question we've got is from Jack, who says, hi Dale, love the show. Thanks matey. Can you please give me your thoughts on NAB and AZJ? Thanks Jack. Now I'll do NAB, I'm not going to do AZJ because we've had quite a lot of stock. There are also some people that put stocks on underneath my recording for last week. Some of those I did on our live show last Tuesday. Actually 2 or 3 of them I did on my live show last Tuesday, and you may have even been the people asking about those stocks, both on my recording and on my live show. So but go to that, but I can't answer everybody's questions at the moment when there's so many coming in, because I want to try and keep these videos to a certain time limit anyway. But let's go and have a look at this next stock, which is NAB. As I said, we're looking at NAB rather than AZJ, because I've looked at AZJ for a few times over the period of time, and pretty much when you're looking at banks, there's only bank that's exciting me or I like at the moment is Commonwealth Bank. You know, NAB, ANZ both look pretty sick. NAB looks very sick. It's been going down there since that high there in September last year. It's been a very, very heavily fall through there. It's been bearish since 2015, so hopefully you're not in this stock. And you can see there from that September, it fell 18.8%. So right now it's not giving me any signs that it's bullish. It's had a nice strong week last week, not too bad the week before. Now it could be turning around. That's possible, but right now, as I said, I wouldn't have been in stock. I haven't been in NAB for years, or we haven't been in NAB for years either. As a fund manager, right now we love Commonwealth Bank. Westpac's not so bad as well. That's the other bank we're preference to. ANZ and NAB we don't. Macquarie's been ballistic. It's a really good bank to be in. That said, I think the run on Macquarie is getting to its last stages, so it's probably not a stock to get into right now. If you do own it, keep holding it. But of the banks, as I said, we're looking at CommBank and Westpac as our second choice in the banks. But thanks for sending your questions in, and thanks for watching till the end of this video. I really do appreciate your participation here. But if you do have any questions for me and you'd like me to answer them, just stick them below on the comments chat, and I'll get to answering them if I can. So get your fingers on the keyboard and start typing. Now remember that here on this channel we do these reports, or these market reports, every week. We also do a live stream every Tuesday night, 7 to 8 p.m. Australian Eastern Time. So get on the show tomorrow night and ask me your questions. They're happy to do that. But also tell your friends. But remember to hit that subscribe button now and click the bell on the right of it so that you know when we upload videos and we go live. YouTube will let you know that from that point of view. But for now, I'm Dale Gillham. Goodbye, good luck, and good trading.